Alrighty, folks, as you can tell by the title, bears are coming back out. We've got two videos we're going to be reacting to today. One, we have Zaman remains constructive on stocks long term, but a correction is coming in the short term. And then we also have, we're going to have a significant economic slowdown in the next 12 months. So we're going to be checking out two videos, giving our opinion on those and seeing what they're forecasting, why the bears are coming back out. Anyway, let's jump right into it. Make sure you hit the like button. Alrighty.
$2.5 billion in July. Short covering, clearly a factor in the market's rally so far, but it's one factor. Do you see short covering continuing to influence the market either to the upside or the downside? A lot of people, including you, believe we're set for a pullback in the next few weeks.
Yeah, so the short covering is...
We basically already started the pullback. I mean, especially if you ask Apple, down almost 10%, right around 10%.
Definitely going to be one of the phenomena that happens towards the tail end when people that have a fear of missing out jump into the market. But we remain constructive on the equity markets in the long term, but we do think that in the short term, the market is poised for a correction because seasonally, September is one of the weakest months of the year in the stock markets. And the S&P 500 has just had the best first 7 months of the year since 1997. So a correction is definitely on the cards.
All right, we have a big week for bond issuance this week. Starting today, actually, we have the 3-year, but this week the 3, the 10, and the 30-year auctions. Look at the 3-year yield, 4.4%. That's a lot of competition for the equity market. How do you see this bond issuance impacting the markets?
So we have clients right now that are really making use of their cash and taking advantage of these bond yields. But if you take a longer-term point of view, we think that there's plenty of opportunities in the equity markets right now, which will outperform the bond.
You know me, folks. We're always thinking long-term here. I'm a 25-year-old, if you didn't know. We've got 40 years of investing ahead of us. We're thinking long-term. We're in Apple, we're in Amazon, we're in Roku, PayPal. We've got long-term trajectory. These small pullbacks are nothing but buying opportunities, regardless of how big or how long they get.
In the long term. So we are looking at some of the less loved sectors in the market that haven't participated in the rally so far.
Which ones in particular?
So a stock on our watch list that we really like is Home Depot, right? So Home Depot did really well during the pandemic because we were trapped in our homes and we wanted to make upgrades. Since then, the demand has subsided, but we see great long-term potential because in the US, we have a housing shortage and people have to upgrade their existing homes, which will benefit Home Depot.
Home Depot is a great stock. I always held it in my dividend portfolio before I sold out and put it all into my growth portfolio. Home Depot was one of my 25 stocks.
Okay, that's specialty retail. Are there any other areas that you see opportunities?
Yes, so these high-quality momentum names that have run up a lot, we would be looking at those on a pullback as well. So stocks on our watch list, Apple and Meta. You know, Apple reported earnings. The street was disappointed because they saw iPhone sales declining. We actually were constructive because we saw their service business do well. And the gross margins on the service business are almost double of the product division. So we are constructive on Apple as well.
Yeah,
I'm very constructive on Apple. Look at that beautiful pullback off of that nice, perfectly solid line. We actually put some money to work today in my fiance's account, buying some Apple today. So very, very bullish long term.
percent growth in that services business, declines in the hardware business. You look at the iPad, 20% decline when it comes to sales. But I do have to ask you, we're looking at Apple shares today. You're saying it's a buying opportunity. Shares down 6.5% almost in the last 2 days since the company reported earnings. Are you worried, even if this is a buying opportunity for Apple, are you worried this might be a story where valuations are just too high, yields are rising, and it's starting to show some cracks in this rally so far?
Yeah, so we would be looking to add positions as the stock declines further. And we think that...
Apple, though.
Apple, yes.
And Meta as well.
We like Meta also, yes.
What about some of the other high valuation names? Do you still feel the same about them? We're looking at an NVIDIA, maybe even a Palantir, just reported earnings yesterday.
Yes, so NVIDIA is another stock on our watch list. We have it in client.
I might be selling some puts on Apple here soon just because I'll beg it to go lower. If it does, we'll be getting some.
Portfolios. We like that as well, but that's run up quite a bit, so we'd wait a little bit more on that. But Meta, you spoke about Meta. I mean, Meta, they've had a phenomenal year. Look at, this year has not only been great for them in terms of cutting their costs, but they've transitioned away towards artificial intelligence to boost the ad revenues. And we think that's phenomenal for the company.
All right, so You're seeing some opportunities in some of those mega cap tech names that have really powered the rally. You're saying any pullback right now is a buying opportunity.
Yeah.
And you don't believe that this bond issuance is competition for those stocks or for the equity market in general?
We think it's competition in the short term, but in the long term, we think equities will outperform. Listen, the Fed waged a war against the 40-year high inflation by raising interest rates to a 22-year high. And it's quite clear that the Fed has won this war. Inflation has come down from 9% to 3%.
Okay.
Economy is still doing fine.
But Aadil, then I have to ask you, what's the catalyst for this pullback? It's not the bond issuance. You don't think it's the Fed. You seem to think that the Fed has things under control. It seems like you...
I'm interested to see what he has to say here because he's making a good point. I mean, everything is on the table. We've known about everything for a while, so I'm not sure exactly why we're pulling back too hard either.
Don't think there's going to...
Unless it's just Apple.
...be a rate hike. We have CPI coming up. If it comes in hotter than expected, is that the catalyst for this pullback that you're calling for?
So we think it's a lot of it has to do with fatigue because the stock market does not go up in a straight line. So I think that at this point, the market will just be looking at excuses. Volume is thin. So we think the CPI and the PPI, if that shows inflation is cooling off, that actually for the long term is going to be good because that means the Fed is done.
But if it doesn't, that fuels the pullback you're calling for?
That would fuel, okay. That could be one of the factors that could fuel the pullback.
A lot going on, Aadil.
All right. So me personally, we might have a short pullback, honestly, mainly because of Apple's pulling back. We've always had several things, always headwinds, all these Fed tailwinds. We know about the hikes. We've hiked into infinity. We've printed more money than we can. And the stocks are all still going up. Nothing's really changed in the last week or two, except for Apple didn't blow out earnings. I mean, they're gonna fit the news around it, but I'm not buying what they're selling. Now let's jump into what Holly Newman has to say.
Could it be a risk to equities? Well, certainly our next guest thinks so. Joining us is Neuberger Berman Private Wealth Managing Director Holly Newman Kroft. Holly's team manages more than $3.5 billion in assets, is ranked by Barron's as one of the top financial advisors in this country. Welcome back, Holly.
Thank you. Good to be here.
I can't say I've heard of this woman, but that's a lot of money. So let's just see. She's one of the best in the country, apparently.
Others are following your negative footsteps. You have said to be cautious pretty much all year.
Yeah, actually going back into last year. No, nothing's changed, but it's sort of refreshing to be here on a down day.
Well, if she's been saying be cautious all year, I mean, how smart is she, honestly? Let's take a look at the Magnificent Seven, right?
Finally, it seems like maybe market sentiment is trying to catch up with all the leading indicators, which have been negative for quite some time. And I've been bearish, as you know, for quite some time. But I think what's happened this year is the market hooked on to inflation coming down, and they just let the market run with that. But now it's hard to ignore some of these leading indicators. The yield curve has been significantly inverted for 12 months, and as you know, a recession typically comes 15 to 18 months.
Now, I just want to be clear. I'm not saying that I don't think that eventually we will have a recession, because this money has to be paid for. These hikes have to be paid for, and the stocks can't go up and just keep ignoring it. So something will give. Apparently, everybody's calling it for the short term. I see it as more the next, 12 to 18 months. We'll have a recession somewhere in there, but I don't think about another year end.
After that inversion, we're seeing contraction in the market. PMI surveys are below 50. And as you may have read recently in the Wall Street Journal, there was an article that some of the major consulting firms are actually delaying the start of their recent college and MBA hires 6 to 12 months, which suggests that they're seeing a decrease in demand for their services. So
is your primary worry now a recession, or is it that the Fed is just going to have to keep fighting the inflation?
Well,
or both?
I think the Fed is at or near the end of the hike cycle. You know, this is the most aggressive cycle that we've seen in years. And I don't think it matters if we just have a slowdown or we have a recession. I sort of think that that's irrelevant. What I do think is our 12-month outlook at NB Private Wealth is that we're going to have a significant economic slowdown, and that the market is going to catch up to the indicators that have been signaling this for quite some time. So my concern is and has been to protect our clients and their portfolios in the face of what we expect to be a downturn.
Certainly, you don't believe earnings are going to come in to fill what's happened to multiples lately.
I don't. I think, we talked about inflation coming down, but if you look at wage inflation, that has been unbelievably high, at multi-decades high, and that's putting pressure on all of the companies and on their profit margins. So it's going to take months for the tightening to work its way through the system and for us to understand and feel the impact of the tightening. We're just starting to see it now. We're just on the cusp.
So what she's saying, I do agree with for the most part. She is, we are just getting to the cusp of it, to where these payments are going to be coming due. The money has to start coming from somewhere. Something has to give, or the Fed won't give, and then that will make something give. So that's not the good option either. We're still kind of in the camp where we could have a soft landing. Actually, we're more towards no landing at all. And I think even we're up so good and we're up so far now that even if we have a 10% pullback or correction, whatever you want to call it, like they're calling, it's healthy. I mean, it's a buy the dip opportunity, in my opinion. It's not financial advice, but it's healthy. Look at how far these things are up. I mean, tens of percent, some of them hundreds of percent. So, a 10% pullback in the market's really not the end of the world, especially with how much weight these 7 stocks have on the indexes. They all could use a 10% pullback. So, it's not that far out of the realm.
That said, though, a lot of people still say the number one wage dynamic is growth in real wages and purchasing power that will drive retail sales, which is most of our economy. Does that not make sense?
Well, as we just heard, we're starting to see car loan defaults, and I think there's still surplus money in the system left over from the pandemic, and that is not evaporated, but it is declining. And where we're seeing a lot of labor market shortage is not in the older population or people near retirement, but it's in the younger college graduate age group. So they might have had surplus money to drive what they're buying and what they want, but that surplus is running out. So I think it's just catching up with us. We've been on this euphoria driven by AI, driven by our labor markets, and it's almost a case of, is good news, the strong labor market, becoming bad news? And is the wage inflation putting pressure on the Fed to have to keep rates higher for longer?
Really not too much new news, besides we've got, who was it? Moody's downgraded the banks, which was pretty big. That plus Apple's still dropping. I think that was mainly why the stocks are down. I've seen some headlines like they're still forecasting recession, but for the end of the year. Kramer's saying buy the dip. There's so much noise both ways. We've got the NASDAQ down about 1.5% at the lows today. The SPY about 1% down at the lows. Come back up a little bit since then, about halfway. There's just so much noise. Nothing really new besides the bank downgrades and Apple being down. I see it as a buy the dip, and as always, make sure to hit that like button, and we'll see you next time, folks.